Markets has been rattled in recent weeks. In part, the spread of COVID-19 outside China and also oil price plunging as Russia and Saudi Arabia walked away from the table. My name is Abel and I have Mr. Heng Kun Hao today to join us to discuss some of the consideration and what you as an investor should be doing. Thank you for joining us today, Kun Hao.
Thank you, Abel.
How long and how low do you think this global slowdown is going to be?
So there's a lot of uncertainty and growing fear with regards to how deep or how prolonged this global growth slowdown will be. Now, suffice to say, the global economy is now undergoing a twin demand and supply shock. Demand is slowing down because we have stopped spending. Supply is getting disrupted globally as factories close down and manufacturing and international trade contract. On top of everything, we have a global oil slump. So that adds more pressure to growth because capex will be cut and credit costs will go up. Now the good thing is that global central banks have started to cut interest rates aggressively and various governments have issued stimulus packages, tax rebates, so on and so forth. So this synchronized monetary policy easing and fiscal stimulus should help ensure that when the virus gets under control, we will have a good rebound. And of course, the low oil prices will act as a positive tailwind. Given the deterioration in the virus outbreak, this rebound is at risk of becoming a much more shallower and slower U-shaped rebound.
Markets has been volatile. In fact, we are seeing spikes we have not seen since the financial crisis. You mentioned that central banks around the world have been cutting rates. How low do you think interest rate is likely to hit?
Indeed, over the past month, interest rates across the world have started to drop significantly. The US Federal Reserve, Bank of England and Bank of Canada have all started to cut interest rates. We now expect Singapore money market rates to drop below 1%. Some countries will challenge the zero bound, and in certain European countries and in Japan even, we will still have negative rates. So in short, interest rates will stay lower for longer.
Thank you very much for your insights, Kun Hao. At UOB, we encourage customers to stay calm and not start heading for the exit. There are a number of solutions out there that we've identified that you may want to consider in the near term. In fixed income, we prefer short duration investment grade bonds, and we prefer to stay away from energy and transportation names. For equities, we like consumption, and that is a play that we prefer, especially in the high quality space. Companies with strong structural fundamentals and also high cash flows. For those who are able to take risks, emerging market equities offers very attractive valuations. For the longer term trends, we prefer Chinese equities. With the structural reforms and a strong domestic market, this offers a very attractive proposition. We also like AI, and as innovation continues to bring products and solutions to the market, we think that this industry has legs to go. Last but not least, we like healthcare. The structural environment has not changed. The world is getting older and living a lot longer. Take Singapore for example. By 2030, nearly 30% of Singaporeans will be age 65 and above. In conclusion, we encourage customers to maintain a diversified and balanced portfolio, to buy into risks when the opportunity presents itself, and last but not least, buy in tranches and not in a single transaction.